Finance Final Audio Study Guide. Take a breath. This class feels harder than it is. Finance is not about math first. It is about understanding what question is being asked. Almost every question on the exam is really asking one of four things. Can the company pay its bills? Is the company using its resources efficiently? Is the company taking on too much risk? Is the company making money? If you identify which of those questions you are answering, the correct choice usually becomes obvious. Now let's walk through the material, the time value of money. Money today is worth more than money in the future. Why? Because money today can earn interest. Future money cannot travel backward in time and earn interest. That is the entire reason present value and future value exist. Present value. Present value answers this question. How much is future money worth right now? Present value is always smaller than future value, assuming interest is positive. Present value is discounted because the interest has not been earned yet. If the interest rate goes up, present value goes down. If time goes longer, present value goes down. Anytime the question says, in today's dollars, or what is it worth today, you are dealing with present value. Future value. Future value answers the opposite question. If I invest money today, how much will it grow to? Future value grows because of interest and compounding. More time or a higher interest rate leads to a larger future value. If the question is about growth over time, that is future value. Annuities. An annuity is a series of equal payments over time. Examples include loan payments, rent, or retirement contributions. If the problem mentions the same payment every year or every month for a certain number of years, it is an annuity. Discounting versus compounding. Discounting means moving backward in time. Compounding means moving forward in time. Present value uses discounting. Future value uses compounding. That distinction alone solves many questions. Capital budgeting decisions. These questions ask whether a project is worth doing. Net present value. Net present value answers this question. Does this project create value? If net present value is positive, accept the project. If net present value is negative, reject the project. Net present value is the best decision method because it considers all cash flows and the time value of money. If you see a positive NPV, the answer is almost always accept. Internal rate of return. Internal rate of return is the rate of return a project generates. Think of it as the project's personal interest rate. If the internal rate of return is greater than the required rate of return, accept the project. If it is lower, reject the project. Payback period. Payback period asks, how long does it take to get our money back? It is simple and focuses on liquidity. Its weaknesses are important. It ignores the time value of money. It ignores cash flows after the payback period. If the exam asked for a drawback of the payback method, that is your answer. Financial markets. Primary and secondary markets. The primary market is where new securities are issued. This is where the company receives money. An example is an initial public offering. The secondary market is where investors trade with each other. The company does not receive money in the secondary market. Stock exchanges are secondary markets. Mutual funds and hedge funds. Mutual funds are highly regulated and open to the general public. They are lower risk and more transparent. Hedge funds are less regulated and usually limited to wealthy or accredited investors. They use higher risk strategies and aim for higher returns. If the question mentions regulation or accessibility, think mutual fund. If it mentions sophistication or higher risk, think hedge fund. Financial ratios. Ratios exist to answer specific questions. The category matters more than the formula. Liquidity ratios. Liquidity ratios ask, can the company pay its short-term bills? Higher is generally better. Current ratio, quick ratio, and cash ratio all measure short-term financial health. On the exam, higher liquidity means safer. Activity or efficiency ratios. These ratios ask, how efficiently does the company use its assets? Turnover ratios are better when higher. Day-based ratios are better when lower. If inventory moves faster or customers pay quicker, efficiency is improving. This category appears often in scenario questions. Leverage or solvency ratios. These ratios ask, how much debt does the company use and can it handle it? Lower debt ratios mean lower risk. Higher leverage means higher risk. Times interest earned measures the ability to pay interest, and higher is better. High leverage increases risk even if profits look good. Profitability ratios. Profitability ratios ask, is the company making money? Margins and returns are better when higher. Return on equity can look strong because of high debt, so be cautious when leverage is high. Market value ratios. Market ratios ask, how does the market value the company? These depend on industry and growth expectations. There is rarely a universally good or bad number. Comparisons matter more than absolutes. Final mental anchor. If you blank, remember this. Liquidity asks if the company can pay bills. Activity asks if the company is efficient. Leverage asks if the company is risky. Profitability asks if the company is making money. Market ratios ask how investors view the company. Test strategy. Slow down. Read the question carefully. Figure out what category the question belongs to before looking at the answers. Eliminate the answer that is clearly opposite. Most questions are testing understanding, not heavy math. You already proved you can pass. Now you just need calm execution.